I'm Paul Schrader. I'm Executive Director of the Consumer Assistance Council. We're located in Hyannis, and we work with the Attorney General's Office to provide consumers with information and mediate complaints. Today, we want to share with you information about reverse mortgages for senior citizens. You can contact us if you have any questions at 508-771-0700. Hope this is helpful for you. What is a reverse mortgage? It is a mortgage like a regular mortgage legally, but unlike a regular mortgage, which starts with a large amount of money that is reduced by payments over time, a reverse mortgage makes payments to you over time, and the balance builds, not declines. Reverse mortgages are appropriate for older people who need extra money to stay in their homes and are willing to use their equity to get that money. For some people, reverse mortgages can be a lifesaver, but for others, they are a mistake. And in some cases, they are part of what is essentially a scam. We will go over examples of each situation.
To introduce our panelists, Jan Timmons is Director of the Sandwich Council on Aging. Jan will moderate our session on reverse mortgages, and our guest experts are Len Raymond, President and founder of HOME, Home Ownership Options for Massachusetts Elders; Tom Kosman, Attorney at Law with South Coastal Counties Legal Services.
I'm going to present some real-life cases and ask Tom and Len to comment. The first case is Miss Jones. Our first example of someone who might benefit from a reverse mortgage is a 77-year-old woman we'll call Ms. Jones. She's a widow whose only income is $15,000 a year from Social Security. Her expenses are running about $25,000 a year, and she has been covering her extra expenses with her savings, but that's almost gone, and she will soon be running about $800 a month short. Ms. Jones owns her own house, which is assessed for $300,000. There's no mortgage, and she has no other debt. She would like to stay in her house as long as she can. Would she be a good candidate for a reverse mortgage? If so, what would be the difference for her if she got a term reverse mortgage through Home or a home equity conversion mortgage, the one you see advertised on TV, insured by HUD?
Well, when you ask a lawyer a question, you always get the same answer. It depends. And that's very much the case with Ms. Jones. It depends on a lot of things that we don't know yet from the example. At first blush, 77, she's starting to be old enough that it can't be rejected out of hand, certainly. In terms of aging in place, that's what reverse mortgages are for. But what I like to do when I start speaking with someone is ask what seem like obvious questions that sometimes get overlooked. How appropriate is the home? She's 77 now. At 90, is that going to make as much sense? Is the only bathroom on the second floor? Does she, here on the Cape, does she live on a street where there's no one around from Thanksgiving through Easter? How big is the yard? How much help does she need with maintenance? The long-term needs of her situation are something you have to look at. And what she's running short now, is that going to get larger as her needs grow, which invariably they do. Another thing we don't have enough information about is her family needs. You like to think in a perfect world that a 77-year-old lady isn't responsible for her children and her grandchildren, but that's never the case. And you need to understand that it sounds like they might be supportive in this situation, but you need to take a look at the larger family, because that's all part of what we're doing. So those would be my initial observations, Lynn.
And we at the Home Program would no doubt piggyback on a lot of what Tom is presenting here, and that is that we really need to do a very comprehensive in-home analysis of our situation, fact-finding, what's going on, build out a budget, look at offloading, which means finding other existing programs, services, benefits. Now, she's, as this example shows, $800 a month in terms of a shortfall is not small. So it might be difficult to get there. But it's certainly well worthwhile to look at that, because at minimum, perhaps you could reduce that shortfall by some significant measure with energy programs, prescription assistance, or something, home repairs would be based on a grant or deferred basis, deferred payment basis. But ostensibly on a purely financial analysis, She probably has, because she has the dynamics are here such that she doesn't have a lot of, a big mortgage, et cetera. So it's a situation where, yeah, she could probably benefit from a reverse mortgage and a variety of reverse mortgages as well. She could indeed qualify for what they would call a HUD-HECM, or some people would call a lifetime reverse mortgage, which tends to be a longer tenure or type of loan. You can stay in the house for a long time. And she would also certainly qualify for what they call a term reverse mortgage. The prime ingredient in terms of the difference between the two would be that the term reverse mortgage would be considerably less expensive, particularly in terms of upfront costs, and it would be a fixed rate. Closing costs are much smaller. And, but it would provide for a more limited tenure or time in the house, perhaps 15 years or so. But it would considerably conserve equity, so that you would have at least 32 to 34% of the value of the property left over at the end of that time for a transition. The real big concern with the open-ended or insured or lifetime or full tenure loan with a HECM would be that it could really deplete that equity. And we have to look at what's going on in today's world. We've had a significant drop in equity in terms of this. They claim now at least 30% drop on average in Massachusetts, probably more here in the Cape. So that would have to be, again, an ingredient in that process. But as Tom noted here, there's a lot of homework to be done. And chief among them would be really sitting down and putting together a long-term plan that looks at, okay, what are the impacts, not tomorrow, not 2 years from now, but 10, 15, 20 years down the road.
Great. Okay, thank you. Now we'll do another case. We have a couple, ages 68, 67, whom we'll call Mr. and Mrs. Murphy. They have two incomes from Social Security totaling $35,000 a year and some income from savings of about $5,000 a year. Their house is assessed at $350,000 with a $100,000 mortgage. They are almost covering their bills, but they would like to have some extra money so they do not have to dip into savings. They would also like to stay in their house as long as possible. Could a reverse mortgage help them?
Again, this is another tough question, because there's a situation here especially important, and that is that they're relatively young, as old as 68 and 67. In general, reverse mortgages tend to work better if they work at all, the older you are.
Yeah, I think over the years I found that to be a truism. The longer you can postpone it, the likelier it is to be viable when you finally get there. I think it's a good rule of thumb.
Plus, there's a lot of coming out here on the front end. We're talking a $100,000 mortgage plus closing costs. That is going to build up interest compounding. Remember, reverse mortgages are unlike conventional financing, and that they are, in some ways, pardon the expression, the mother of all loans, and that they not only are going to have steep interest that's adjustable, but it's a situation where you're going to have a monthly adjustable. You're going to have essentially a loan that has compounding as a feature. That is, every month that interest compounds. So to start off with, let's say $115,000, $117,000 worth of debt, and there will be also monthly insurance fees, not hazard insurance, but insurance that deals with the mortgage insurance, which is actually calibrated to the size of the principal balance. That means as that principal balance gets larger, that monthly insurance feature gets larger as well. Plus there are servicing costs, which are also set up on a monthly basis. So it's all very, very costly. They're in a tough situation. I think we would have to have a very broad view in terms of what their options are, including transition and saving as much equity as possible for that transition. They're all difficult questions. On a term reverse mortgage, they could perhaps get as much as 8 to 10 years and still save a good chunk of equity in the vicinity of 32, 34%. Whereas on the open-ended insured reverse mortgage, and again, these are generalities, but I think we're getting close in these individual cases. You're talking about a situation where within about 10 and a half to 11 years, most of the equity in that house would be used up. There'd be no equity left. So then the question begs itself, what do they do at that time? And what would happen in the future if, for instance, inflation, rising costs, taxes go up, health questions, home maintenance, deferred maintenance with most seniors? Those are all important questions.
Very complicated.
Yeah, well, and I'd have just a couple of other observations. One is when it always amuses me when people say that, well, I want to get a reverse mortgage because I don't want to dip into my savings, as if the house somehow represents a different kind of money than a CD or an IRA or something does. And I guess part of that is because even with this real estate downturn, most of us are lucky enough to own houses that are worth more than we paid for them. So it does seem like found money somehow, but it's every bit as real a part of your nest egg as anything you might have in the bank. 67 and 68 is pretty young for reverse mortgages, but it's not too young to be thinking about planning for the rest of your life financially. And with a husband and wife and a home, one of the few last-second planning mechanisms that's still available in the case of a nursing home placement is the home is an exempt asset. You can transfer it into the healthier spouse's name. You can shelter some money by paying off mortgages. Now, if you get into a reverse mortgage thing, the ability to pay off the entire reverse mortgage if you need to start shuttling funds is a lot more difficult than it would be to just address this. Then you have the availability of a reverse mortgage for the community spouse, the person who doesn't end up in a nursing home, if God forbid that's where you're at. It's way too complicated to get into at length here, but the important thing to realize is for most of us, the home, liquidity issues aside, and that's always difficult for a senior because cash flow is an issue when the furnace goes or the transmission in your car or something, but that aside, the way most of our benefits programs are structured, you're better off as a low-income senior to have your equity in your home, which is exempt from counting for needs-based programs like food stamps or SSI or medical assistance. You can get tax abatements. If you file a homestead declaration, you can protect your home from your creditors, whereas if you've got money in the bank and default on your credit card loans, you run some risk of creditors coming at you rather aggressively. So, like I say, it seems like it's free money and why not use it? It's every bit as real as money you've managed to save otherwise, and in a lot of ways, it's the last money you want to be spending and not the first. That's what I liked about the first lady. She was almost out of savings. That's you want to have that little hedge, but you don't want to, I get people who say, well, I don't want to sell my stock because it's down right now, and let me get a reverse mortgage. Well, your house is down too. Your borrowing power of your house is down commensurately with your stock. So you need to, the one thing we're getting across here is it shouldn't be done lightly. This is not a decision you make in 20 minutes after you see a commercial or go to a seminar.
And to redouble Tom's comment, I'm always puzzled. We've been working at the home program for almost 30 years with seniors, and too often, it's remarkable in a sense, people don't seem to grasp, Social Security may very well change over the next decade. Who knows what's going to happen to Medicare, other needs-based programs. But goodness, if you know what your house is worth, and that is a real asset, it's very fungible, it's very tangible, it would make much more sense to hang on to that and shepherd it very, very carefully over the course of your retirement. That could become an incredibly important bridge in the future to help you out of any number of different situations.
Okay, thank you. Next case is a woman we'll call Miss Adams, who's age 75, and has been approached by her investment advisor about an annuity. He says that if she takes out an annuity with his company, she'll get a guaranteed monthly income for life. He suggested that she take out as much as she can from her house using a reverse mortgage and invest that money in an annuity. Her house is assessed for $280,000 and she has no mortgage. She has a small income from Social Security and a pension left to her by her husband totaling about $30,000 a year. And she is meeting her bills, but she's worried about the future. She likes the idea of a guaranteed extra income to give her a cushion. What are your thoughts about that?
Well, I don't doubt that her investment advisor would like her to do it. It's several things. First of all, this is, everything else aside, a terrible time to be taking all your available cash and putting it in a lifetime annuity. Interest rates are historically low. The payback for that, if inflation takes off, and it's hard to imagine at some juncture it won't, you're locked into that lifetime annuity. There are ways of having the resources that your home represents available as a cushion. Line of credit options and things like that in reverse mortgages, where you only get it as you need it, as opposed to getting it and setting it aside. you know, it's worrisome that, and people are, I know for a fact that people are out there getting bad investment advice because they're getting it from people who are only looking at one side of the coin. This is alarmingly like a case I saw last year where a lady came in, her husband had just gone to a nursing home, and they had a handsome retirement income by our client standards. Working at legal services, most of my clients don't have that, but it wasn't enough to pay anything like what the nursing home cost. And the advisor said, well, cash out, max out your reverse mortgage, give me the money, and I can generate the money to pay for the nursing home each month. The trouble with that is we never know how long somebody's going to live in a nursing home, first of all. Secondly, it was their one remaining resource, and as I said earlier, your home is the one tool that we're allowed to use as a planning mechanism at the last second in nursing home situations. She would have been far better off getting the house transferred to her name, which you can do without penalty between spouses, even at that juncture, and getting a reverse mortgage to supplement her own income. She would have needed to draw it out at a much more modest rate, and only as she needed it, as opposed to a lump sum, which borrowing that money up front is a very expensive thing to do. So no, it's understandable to say, you know, I am just meeting my expenses, but boy, every time the refrigerator makes a grating noise, or so, I worry, how am I going to deal with this? There are ways of doing that. I mean, she is comfortable financially. She is not perhaps as liquid as you might like, but there are ways of addressing that without having to cash out the house and tying her hands. I mean, her ability to respond to what the future holds is severely constrained if she takes this route.
Right, and certainly, as Tom is outlining here, locking up that asset is going to foreclose a lot of other options or avenues to her. I mean, there's a whole set of comments. We're not going to. This is probably not the appropriate place to deal with it. But obviously, the gentleman selling the annuity, it's a commission situation. Sure. You know, not to say that in some instances it may make sense for someone to do that, but we would look at this as, you know, only as again, if we're totally sure that all the pieces fit together well and right and correct for her. And I would redouble that issue of, okay, what else is she eligible for? What else could she possibly get in terms of low cost, no cost benefits and other offloading options? But in addition to that, this whole idea of why not an equity line, a conventional one. If she couldn't afford that, for instance, the home program has an equity line of credit for seniors. Again, which is only, you're only going to draw down money when needed and only be charged interest on it when that actual occurrence goes on. So, and also they're structured so that they're going to give you a lot more options down the road and preserve even a greater amount of your equity for perhaps another kind of financial product and refinance that would, again, add to your tenure in the home.
Excellent. Okay. Our next case is a divorced woman, 66 years old, and needs to retire because of ill health. When she does, she will no longer have enough income to cover her mortgage and other bills. She will be almost $20,000 a year short. She has a plan to bring her lower retirement income and expenses into line, and that is to move into senior housing, where rent is 1/4 of her income. She has picked the senior housing complex and is in which she wants to live, but they have a 2-year waiting period. She would like not to have to move twice, and thinks that a reverse mortgage could cover her bills while she waits until she gets admitted into senior housing. Her condo is assessed at $250,000, and she has a $100,000 mortgage. She called one of those people that you see on TV talking about reverse mortgages and was told she could get a mortgage, but the upfront fees would be about $15,000. These would be added to the amount borrowed. Since she plans to pay the mortgage off within the next 20 to 24 months, she thinks that this is awfully high price to pay for this loan. Would a so-called term reverse mortgage work for her?
Well, I certainly think that this client strikes us as one who's been doing some very thorough thinking about this process and what her options are. And there's no question that on a lifetime-oriented insured reverse mortgage, the costs are incredibly high. And for a short period of time, or what we may call an intermediate period of time, it would probably not make a lot of sense financially to do that. And in fact, we have many clients who come in who have done excellent planning in the sense that they do indeed intend to make a transition from the house. Here, she's talking approximately 2 years. And we have to compliment her because she's gone out there and done her homework and checked what those elder housing options are for her. It would make sense for her if she wanted to, if she couldn't hold out and couldn't find the substitute, let's say, services and benefits to kind of make up the
Right.
gap. To look at a term reverse mortgage may work very, very well for her in the sense that it's going to be a much lower cost to set up, perhaps around $2,500 to $3,000 maximum. It's going to be a fixed rate. There won't be the additional insurance and service charges of the other loans. And unfortunately, there will be compounding interest, but this would be over a shorter period of time. So she would, we would recommend that she would do this more than the 2 years, because obviously, let's say 5 years, if she leaves in 2 years, she's only going to pay for the 2 years. So she won't incur that entire amount of indebtedness. That option may work very, very well for her under some circumstances.
Yeah, that said, though, once again, I mean, reverse mortgages are not some kind of a magical elixir. Yeah, here you can see where it makes some sense, but it's not without some drawbacks too. Even in this, yeah, lifetime plan. Why pay when it's not part of your lifetime plan? Why pay those closing costs? And it'd be hard to structure anyway at her age and with the upfront load. A couple difficulties, though, is that when your name comes up on that subsidized housing list, you're not going to have the 9 months to sell the house that it takes these days. I mean, that's you get a little warning, but it's you could either take the place next month or not. And if you have a house, you may very well not be eligible for that unit. Owning real estate is something that disqualifies a lot of people. The other thing is, depending on how long this lady's been in her home, I mean, I understand not wanting to move twice, but downsizing from a single family home to an apartment is not an easy thing. If she's been in that house 20 or 30 or 40 years, she's not going to be able to do it in the 6 weeks when they say, hey, your place is ready if you want to lease up by December, otherwise go back to the top of the list, which is problematic. So it might make some sense to at least think about, even if you put the house on the market today, it may be the full 2 years before you move it. It may very well be that if you want to put the house on the market today, you've deferred maintenance and it's not as saleable as it would in a tough market. You want a house that shows as well as possible. And if you're a senior who's been on a fixed income for quite a while, your home probably is not showing its very best. Floor coverings and overgrown bushes and vapor leaks in the double glazed windows and things like that. That any realtor says if you put in a few $1,000s, it will make your house a lot more marketable. So there are ways of using reverse mortgages, even if you're committed to a sale. You say, well, but I can't. If it takes 2 years to sell, I can't maintain it in the meantime. What do I do?
Right.
You can, but I think she needs to think about selling before her name comes up on the list 2 years hence. It's a great end-of-term plan. It makes a lot of sense, especially here on the Cape. We have a lot of senior housing, and it's pretty nice, but it's not automatic. It's not without its own headaches, and it certainly isn't a space she's used to. So my advice to her would be, even if you want to go a term reverse mortgage route, and it's hard to see anything other than a term loan making any sense at all for her, don't say, okay, I don't have to worry about that for 2 years. Yeah, you still do. So.
And proper planning would encourage that you look thoroughly at this issue of selling sooner rather than later.
Okay.
Because why incur more debt, have less equity left over for your remainder life planning and that other process. Also, we would certainly suggest that she would cast a broad net in terms of not just looking at one particular development, but looking at, our usual recommendation is 5 as a minimum to do that as well. And also to do that very thorough planning in terms of that sale process. If indeed it's a matter of she's not going to sell immediately, then you're going to have to start that process again very early on compared to rather than waiting. The longer it is, perhaps the more difficult it will be at that point in time.
Excellent point. Thank you. For our final question, just in general, how does someone figure out whether or not a reverse mortgage is really going to work for them, and how do they avoid making mistakes?
Well, I wish there was an easy formula for that. I don't think there is. I would, and every individual situation is different, given people's different circumstances. Individuality reigns supreme in this realm, absolutely. Again, our approach to this is reverse mortgages, or any loan for that matter, of refinance or financial transaction, should be a last resort. Okay. And what you want to do is to look at everything else first and go through that process. But you need to inform what your ultimate decision will be based on what's possible financially and how well that serves you. But certainly, you need to do it within a long-term context. what we call, again, remainder life planning. And again, it's difficult because obviously when many of our clients will sit down with them across the kitchen table, it's a situation where an elder widow is just trying desperately to make sure she can pay the gas bill at the end of the month. But you have to try to transform that process into, well, let's look at this 12, 15 years down the road and what is possible and what works and what doesn't work. But that's where you need to go. And it took a long time to get to this point in terms of one situation. That means we have to invest a lot of effort into what we're going to do now in terms of this analysis, depending upon family members, if they're good advisors, whoever professionally is a good advisor out there to get involved with that, et cetera. And certainly you need to have good, unbiased third-party counseling to look at what all those options are. And certainly we have a terrific legal service program, although we know it's having a very difficult time with resources down here, but nonetheless, I'm not trying to add to your client load, my friend, but nonetheless, we're all in that situation. It's a matter of relying upon that expert advice and going about this in a very methodical and careful way, not to rush into it.
Yeah, and I guess, just doubling on what Len says, an objective counseling process is what's really important, because we're talking about our homes, and when you sit down across from somebody at their kitchen table, it seems obvious, but it is their kitchen table. I mean, there is an emotional component that an elder brings to this situation that you can't discount. It's hard to place a dollar figure on it. It depends how long you've been there, whether you were there with your spouse who you've lost, whether you raised your kids there. But we get real tied up emotionally, and that makes it hard to deal with it as objectively as we might. Same thing with relying on kids as the source of objectivity, because they're not. They are generally our heirs. They're also the ones who ideally are concerned about how we're making it. You want to think that your interests are paramount to them, but they're different people. They have different situations. So you can't rely on, it's good to involve them in the decision-making process. It's not necessarily a good idea to depend completely on them, because they don't have the ability to be completely objective either. And I guess the one thing, Len and I were talking just yesterday in preparation for this show, the one thing that I ask people to think about when they're trying to decide what to do with a reverse mortgage, I tell them, if through some kind of magic we could have sat down 20 years ago and watched a videotape of your life today, some of it would have been pretty predictable, and some of it would have been out of left field that you never saw coming. Well, that's equally true for 20 years from now, too. If we sat down and saw where we're going to be at 90 or wherever the borrower is, some of it we're going to see as predictable, and some of it we just never in a million years would have guessed that was coming. And your ability to respond to those unanticipated changes is got to be the driving force. You want to retain as many options as you have. And as soon as you start tying up your house in these loans, options restrict themselves. That doesn't mean it's necessarily a bad idea, but you want to look at it with how can I preserve my ability to respond to the future as best I can? And I think that's the one question I'd ask people to ask themselves.
Right, and again, to strongly reinforce Tom's point here, is that any good financial plan that I know worth their salt is certainly going to say one of the real deficits with a reverse mortgage or an elder equity conversion option is the further you go down the road, the fewer and fewer the other options and alternatives you have. Because what you're doing is you're using up that asset.
Yeah, thank you.
Oh.
Len, Tom, thank you very much.
Well, thank you,
very much.
Jan.